Hi students, welcome to my class. This is Professor Vincent Saga, and this is the presentation of part 1 of chapter 6, Merchandise Inventory. In chapters 1 through 4, we learn different accounting principles and how to apply them for the preparation of financial statements. And we also talk about how to prepare a set of financial statements. And of course, as you know, the financial statements consist of valuable information that is used by different constituencies for different purposes, for making different business decisions. Then we also talk about using ratio technique in analyzing the financial statements. Now we talk about all of those issues from the standpoint of a service type of company. In chapter 5, we repeated everything we discussed in chapters 1 through 4, however, from the standpoint of a merchandise company. That is a company that buys finished goods and turn around and sell those goods to the customers. Now, in chapter 6, moving forward, we are now going to zero in on one particular line item on a particular financial statement. So in this case, chapter 6 zeroing in on merchandise inventory. Merchandise inventory is an asset. It is reported on the balance sheet, and we are going to talk about the related accounting principles or rules, how to apply them for the preparation of financial statements. So that is the overview of chapter 6. Now, we have 7 objectives here. The first one is we are going to identify, like I indicated, different accounting principles and controls relating to merchandise inventory, how to apply those principles in order to prepare complete, accurate financial statements in accordance with generally accepted accounting principles. So that is basically the overview of the chapter. Now, moving along, let's take a look at the first objective. Again, we indicated that we are going to identify some accounting principles. So what are the accounting principles and controls that relate to merchandise inventory? Now, why do we need these principles? Like we indicated in the previous chapter, we need to understand these principles, and these principles are universal, not necessarily universal. In the United States of America, these principles are the same, so that every accountant in every setting understand the principle, how to apply them in order for us to come up with almost the same result. Now, here are some pertinent principles or accounting principles relating to inventory. Number 1, consistency. Number 2, disclosure. Number 3, materiality. And number 4, accounting conservatism. So let's take a look at each of those principles. Number 1, consistency principle. What does this mean? Generally accepted accounting principle requires us to use one accounting method in one accounting year or accounting period and use the same method consistently in subsequent periods. In other words, you cannot use one particular accounting period, one accounting method in one period and change to another method, because in accounting there are some situations whereby we have multiple methods that can be used to account for only one thing. So if you have 4 different methods and you choose one, you need to be consistent in subsequent periods. That is what we mean by consistency principle. Why does the rule require us to be consistent? Because if you keep on changing different methods in treating one particular thing, then comparing your financial statement from one period to the other becomes a challenge. In other words, you wind up, the financial statement user will wind up comparing apples to oranges. So that is the reason why the consistency principle is very important. Now, that does not mean that you cannot change the principle as time progresses. If you change, you have to justify the reason for the change, and moving forward, you have to stick with the principle that you wind up changing into. So moving along, the second principle is disclosure principle. What does this mean? listen to this very carefully. Remember we talked about a set of financial statements? In real life, if you take a look at financial statement of a company, the very first page could be the cover sheet. The second page could be income statement. The third page could be the balance sheet. The third page would be statement of cash flow, so on and so forth. Guess what? These financial statements, as we have already learned, have bunch of numbers, bunch of figures on them. There are a lot of valuable information relative to these figures that you are not able to obtain by looking at the figures. So subsequent pages of this set of financial statements, maybe the next 10 pages or 20 pages, however the case might be, would deal with narrative description of important issues or important accounting principles that were used relative to how the numbers were derived on the financial statement, or how the numbers that were reported on the financial statement. So that is what we mean by disclosure principle. Moving along, here's an example of disclosing inventory information for a real life company. Now, let's take a look at materiality concept. That is a very important concept relating to inventory. What does that mean? It says here that, when a company omits intentionally an information from the financial statement, as long as the information is not significant enough to make a difference in the user's decision as to whether to use the information or not, we say that that information is not material. So, in other words, if an information is omitted or misstated and the information is significant enough to throw off somebody, then we say that that information is material. Okay? Now, materiality is relative. What do I mean by that? What is material for IBM, the amount that is material for IBM or immaterial for IBM would be material for your neighborhood grocery company. In other words, another example would be if Oprah Winfrey lose $100 bill, what is the likelihood that she will have a couple of sleepless nights over $100 bill? Not likely, because $100 is not material for her. But for you, if you cannot find the $100 bills, I bet you will have at least a one night a sleepless night for losing $100 bill. So again, like I said, materiality is relative. Now, let's take a look at the next principle, conservatism. This principle simply states that when an accountant is in a state of dilemma and you are torn between using this approach versus using that approach, or using this method or using that method, the accounting profession requires us to use the method that would make us look less favorable. In other words, by so doing, we are being conservative. So that is the conservatism principle. Now, let's take a look. Now, I haven't talked about those pertinent accounting principles relative to inventory. Now, let's take a look at the control over merchandise inventory. What do we mean by controls? Controls are the policies and procedures that a company put in place to safeguard their inventory, to make sure that inventory is properly authorized, is properly recorded, so on and so forth, to make sure that the inventory is protected against theft. So all those policies and procedures that you put together to make sure that all these things are in place, we call those controls. So they have a list of different controls in place. Now, moving along, let's take a look at the second objective. Account for merchandise inventory cost under a perpetual inventory system. Now, we have two methods for accounting for inventory system. We have the periodic inventory system, we have the perpetual inventory system. And we did talk about this extensively in chapter 5. But suffice it to say, at this point in time, we are going to zero in on the perpetual inventory system. And the periodic inventory system will be briefly discussed at the end of the chapter. Now, moving along, how are merchandise inventory costs determined under a perpetual inventory system? Now, this is very important. There are two key issues here. At the end of the accounting period, the question is, what is the cost of ending inventory? Whatever inventory that we have, how much did we pay for them? What is the cost? We're not talking about selling price, we're talking about how much it cost us. Now, the second thing is we also need to determine the cost of goods sold. Now, let me give you a very simple example so that you can have a good understanding of this. So, here's a simple example. At the end, let's say during the year we bought 10 shirts, all right, as inventory, and we paid $10 for each. That will give us $100. So we paid a total of $100. Now, we sold 8, we purchased 10, we sold 8. So we have 2 left. Now, at the end of the accounting period, the question is, what is the ending inventory? In quantity, we have 2 units left. But that is not what we are going to report on the balance sheet when we prepare the financial statement. We have assets, inventory. Now, when we report the information on the balance sheet, we are not reporting 2 because we are reporting inventory in dollars. The question is, what is the cost of the ending inventory? Since we bought each shirt for $10 and we have only 2 left, clearly the inventory at the end of the accounting period is 20. So that is the first thing that we determine. Then the second thing is, what is the cost of goods sold? How many shirts or units did we sell? We sold 8. What is the cost of the 8 shirts that we sold? We paid $10 for each. If we paid $10 for each and we sold 8 shares, clearly the cost of the 8 shares that we sold is $80. That's simple. So why do we need that? Because on the income statement, when we are preparing the financial statement, we have sales, we have cost of goods sold. Now, sales will be determined by the selling price. I mean, we sold 8 shares. We are not going to sell each share for $10 because we bought each for $10, so we can't sell each for $10. So let's assume that we decided to sell one for $20. So if we sold one for $20, then we are looking at $160 in sales. Now, the cost of goods sold, we sold 8 and it cost us $10 each. The cost of goods sold would be $80. Now, of course, the difference will give us $80. We call that gross profit. We talked about this extensively in chapter 5. So these are the 2 main issues: ending inventory, the cost of ending inventory, and the cost of goods sold. Now, moving along, how are merchandise inventory costs determined under a perpetual inventory system? So take a look at this slide, and I don't know whether you are able to see this very clearly, but you have the benefit of your slide or your PowerPoint. Take a look at what happened. August 1st, we started with 350. We actually started with 2 units. Each cost us $250. And then on August 5th, we bought 4. We now have 6 altogether. and each cost us $350. So you can go through this on your own, because this is basically repeating everything that I just explained few minutes ago or few seconds ago. So this will be the end of the of part 1 presentation, and we will take it from there in part 2.